All right, we'll start kicking things off here, and this will be recorded as well. So if anyone has to drop off at any point, we will send out the recording afterwards. So welcome everyone to today's webinar. My name is Brian Belay. I'm on the board of the Crowdfunding Professional Association and also the founder of crowdwise.org, where I help investors learn more about investing in the private markets, specifically through equity crowdfunding. Now today, I'm very excited to be joined by Tim Barry. Tim is an expert in the field of self-directed IRAs, over 20 years experience. I'm going to let him kind of give his own intro in a second so I don't steal all his thunder. But we're very fortunate to have him as he is a wealth of knowledge. And so today's webinar, we are going to be diving into the details of self-directed IRAs and 401ks and potentially investing in alternatives using those accounts. What are the pros, the cons, pitfalls, that type of thing. Now, as with a lot of these webinars, just want to make the disclaimer up front. Everything we're going to be talking about today is for informational purposes only. This is not for professional legal, tax, investment advice. Always consult with your own professional. So none of the advice we're going to be talking about will be personalized, but if anyone does have general questions in terms of how these accounts work and that type of thing, feel free to use the Q&A throughout today's webinar. So in the bottom, you can submit any questions that you have, and we'll be taking those questions as we go along. All right, with that, let's kick things off. So Tim, thank you for joining us today. Why don't you kind of give us a quick intro of your background and what it is that you do?
Sure. Thank you for having me, Brian. My background, you pretty much hit it on the head. I've been dealing with self-directed retirement plan issues for the last 20 years. Actually, a little bit more than 20, but I only like to say 20 because with the gray hair and the age thing freaks me out. But yeah, I've been dealing with self-directed retirement plans for quite a while. I've seen a lot of interesting situations. I've done a lot of interesting cases. So that's what I do, deal with self-directed retirement plans.
So when you say self-directed retirement plans, what is that? What for the people who maybe are just hearing this for the first time, what does that really mean?
Well, what that means is a lot of people, they have their self-directed IRAs. So we do a lot of stuff with IRAs, with Roth IRAs. It could be a SEP, it could be a simple. But then also you got something called 401k plans, which are typically a little bit better than the IRAs are. And then you got the profit sharing plans. So pretty much anything that's tax exempt and gives asset protection is going to be a retirement plan. So that's the area I go to is tax exempt and asset protected entities.
Got it. Now, if someone is starting to learn about this and you as an expert are saying there's some of these potential benefits, who are the people who can potentially benefit from having some of these self-directed accounts? Like, what are the situations you see where it would make sense for someone to really consider this?
Kind of the simple answer is anybody. I mean, and I don't want to be overly facetious on that, but I mean, the two big mantras, once again, tax exempt. You can build up money and not pay taxes on it, and they're exempt from the claims of creditors. I mean, how cool is that for your investment capital? So if anybody has excess income, excess capital, and they want to invest it and they want to make sure it's not taken away from the IRS doesn't take it away, and some frivolous lawsuit doesn't take it away, those are going to be the ideal candidates, which once again, it's pretty much everybody.
Good. And I mean, kind of the flip side of who it's good for, but I know that with over 20 years experience in the space, you must have seen a lot of the mistakes that people make. Can you maybe take a few minutes and just talk about what are some of the pitfalls and mistakes that you most commonly see or that people should be looking out for when looking into these plans?
Sure. There's a set of rules called the prohibited transaction rules. And those rules basically say you can't use the income or the assets of the plan for your personal benefit, and you can't engage in a transaction with anybody related to you. So if you can avoid those two little hurdles, you're golden. Now, how have people messed up? Gosh, 6 or 7 minutes before I logged onto this, somebody said, Tim, can I take a salary for managing my retirement plan? And the answer is no, you can't. You're using the income or the assets of the plan for your personal benefit, paying yourself a salary. That'd be a no-go. That would be a mess up. And going a little bit further, if you did pay yourself a salary, that's ordinary income plus employment taxes of 15.3%. Whereas if you just took a distribution as ordinary income and a 10% penalty. So it doesn't make sense economically either. Other thing we see is real estate agents. They'll get a commission on real estate inside the retirement plan. That's a no-go also. That's going to cause the thing to blow up. So once again, if you just repeat the two basic concepts, you can't use the income or the assets of the plan for your personal benefit other than whenever you retire, and you can't engage in a transaction with anybody related to you. If you can go around those two little hurdles, you're golden. There's just so many things you can do, but unfortunately, a lot of people feel like the only people they can buy real estate from is themselves or close family members. It's weird.
Huh. So you mentioned one interesting thing there that I want to dig a little deeper on, and that's, these prohibited transactions. So I think a lot of the investors on the call today and that are part of the CrowdWise community are perhaps interested in investing in early stage companies, startups, whether it's, angel investing. Some of them, I'm sure, also diversify into real estate. Can you maybe briefly touch on, when you say prohibited transactions, what are the things people need to watch out for?
Got it. And that's the cool thing from those pre-existing investments, if you will, the crowdfunding investments. Chances are it's not your parents running this investment. It's not your kids running the investment. It's not your spouse running the investment. And that's one of those PTs. You can't do any transactions with anybody who's close to you. That would be parents, spouse, kids.
So that doesn't apply to friends. If I know a colleague or want to invest in someone personally, does that fall under that?
As a general rule, no. There's a little, let's just keep it really simple. No, it doesn't apply to college friends. Weirdly enough, it probably doesn't apply to brothers and sisters, aunts and uncles. So that's one of the beautiful things of these crowdfunding programs is, once again, they're not going to be run by your close family members who's going to cause a PT for you to be invested with.
And just for clarification, when you say PT, what's that?
Oh, I'm sorry. Prohibited transaction.
Perfect. Yeah, I just want to, for my own clarification, as well as I'm sure those in the call, a lot of the acronym soup sometimes can get you a little jumbled up.
Yeah.
It's all good. Okay, so I think moving on, when some of these investors are looking on some of these crowdfunding platforms, to invest, how would they actually go about doing this? Can you maybe walk us through logistically, like what is the process that someone would go through to open up one of these accounts or kind of get this structured so that they can start making these investments?
Yeah, that's the cool thing about a lot of these new alternative investments, crowdfunding investments, is they pretty much have these prepackaged deals, if you will. You go to them, say you want to use your IRA or 401k to invest in these. Many times they'll already have a custodian for you to use who has all the paperwork, and you just press some buttons and your retirement plan's made the investment. So really the first step is talk to the investment provider. See, do they already work with a custodian? If they work with a custodian, cool. Move your money to that custodian and now make the investment through that custodian. If you already have a self-directed retirement account, you can talk to them and say, hey, I want to invest in this crowdfunding project, or I want to invest in this alternative investment. Here's the paperwork. Please move the money. So if you already have the self-directed IRA, just talk to your current custodian and tell them this is the investment we want to make. What paperwork do I fill out? And send them the money. So for the most part, these can be done very, very easily.
Got it. And in terms of, the types of entities that people are investing in, is there anything they need to be looking out for if it's, whether it's a C corporation versus an LLC? Are there any kind of special rules or gotchas that people should be looking out for there?
Yeah, great point. With a C corp, first off, if an IRA, if a retirement plan invests in a S corporation, it's probably going to blow the S selection. So not many retirement plans are investing in S corps. So then we got C corporations, which means the corporate entity itself pays the taxes. The tax liability stays at the corporate entity. Whereas with the LLCs, they're a pass-through. The tax liability passes through the LLC down to the retirement plan. Now, why do I mention that? If a retirement plan receives income that is based upon an active business, the retirement plan has to pay taxes, and the taxes are at 37%. And that's just federal. Then we get hit with the state garbage too. So if your retirement plan is going to invest in an entity that is running an active business, you want to make sure that's going to be a C corporation where the tax liability stops at the corporate level, Corporations, C corporations currently only have a tax bracket of 21%. So that's going to wipe out close to half of your tax liability. So if it's going to be an active business, ask the investment provider, hey, is this going to generate active business income? If they say yes, make sure you got a C corporation blocking that income from hitting the retirement plan. But if it's just doing passive investing, some real estate or whatever interest or royalties, then the LLC is fine with the pass-through.
Got it.
That was way too much, wasn't it?
No, I'm like digesting all this. This is great. This is exactly the kind of detail, I think we're going to have a mix of people who the self-directed, IRAs and everything, this is going to be a whole new world. And I know we have some people on the call as well who really want to dig into some of the nitty-gritty details of the different laws. So this is all perfect.
Cool.
So let's take a step back maybe for some of the more basic introduction for people who are considering this, but people are maybe familiar with Roth versus traditional or, taxable, non-taxable kind of accounts. What does that look like in terms of setting up self-directed accounts? Do you have the ability to do both of those, or what does that look like?
Yeah, you can, any sort of retirement plan can be self-directed. So if you have a traditional account, which means you got the tax deduction whenever you put the money in there, and then whenever you take the money out, you're going to be hit with taxes, you can self-direct that. A Roth account, you don't get the tax deduction with the money going in, and then it grows completely tax-free. And then whenever you take the money out, woohoo, no taxes due on that. That can be self-directed. Inherited accounts, if you inherit an IRA from somebody passed it on to you whenever they died, that can be self-directed. So pretty much any retirement plan, and I don't know why I said pretty much, any retirement plan can be self-directed. Hell, you can even self-direct HSA accounts, health savings accounts, and or educational IRA accounts can be self-directed as well, and all sorts of neat things.
Very interesting. Now, I know there was also, some more advanced things that you can do with some of these accounts. One of the ones you were talking about was maybe, taking distributions. Do you want to kind of talk through that? What are some of the creative ways that you see people kind of using these accounts?
Man, there's just a ton of different things. Creative ways. I mean, I literally had one guy, he invested in Pee-wee Herman's movie, and the royalties from that movie were flowing inside his retirement plan, tax-free. How cool is that? And then whenever it comes time for distributions, it's really fascinating. Tax code says you have to pay taxes on the fair market value of the assets distributed. Now, the interesting thing is, if I buy IBM stock and I distribute that stock out, I pretty much know what the fair market value is. The stock market's going to tell me, oh, that's worth $38 today. If I distribute cash, I pretty much know what the value of that cash is. It's worth $1. Each dollar is worth $1. But let's say I have 123 Main Street, a property, 123 Main Street inside my retirement plan, and I take a distribution of that out of my retirement plan. What's the fair market value of 123 Main Street? Do I go out and get an appraisal? Can I use Zillow? Can I use Redfin? What's the fair market value of it? But let's go a little bit further. Let's say I've got 123 Main Street, but my IRA only owns 50% of 123 Main Street. And now I distribute that out. What's the fair market value of ownership of 50% of 123 Main Street whenever the other 50% owner has the right to come in, open up the fridge, see what's in the fridge, watch TV, et cetera, so forth? Is it going to be 50% of the entire value? No, it's not. There's going to be a discount, a valuation discount. So there's different ways on how, whenever you have assets inside the retirement plan, you can slice them and dice them. And as you slice them and dice them, they lose value. And as they lose value, then you can start taking distributions and saving taxes on that lost value.
Got it. And I think you also talked about potentially another way of taking a distribution, using the money to invest and, paying it back within 3 years. Can you maybe talk about what that strategy looks like?
So I done goofed. That's what you set me up for before.
It's all good.
Okay, you did a lob ball right at me, and I thought, huh, what? That's funny. Yeah, well, no, this is a cool one, and this is a this year special. This is a COVID special. Under the tax code for COVID for 2020, you can take a distribution of up to $100,000 from your retirement plan, so long as you've been affected by COVID, which I think everybody has. You can take that $100,000 distribution. There's no early withdrawal penalty of 10% like there is normally. And now the tax code says your tax liability on taking that distribution is spread out over the next 3 years. So you're going to pay those taxes in 2021, 2022, and 2023. So now you got full use of that to invest. You got 3 years to pay the taxes back. And then also at the end of 3 years, or right before the end of 3 years, you can pay all that money back, the $100,000 if you took the full thing out. And then you can say, hey, IRS, I took the distribution of $100,000. I paid taxes on it, but I put the money back. Give me my money back. Give me my taxes back on the $100,000. And they got to do that. So that's a fantastic thing with the COVID right now, where you can basically get the money out of your retirement plan, invest in assets that are going to generate long-term capital gains as opposed to ordinary income on distributions, and save some taxes that way.
Got it. Very interesting.
And Brian, let me go to double bonus round. Is it okay if I go to double bonus?
Oh, please, yeah.
Okay. Double bonus round is if you've got a 401k you're using as your retirement plan, you can put away, a little bit over $50,000 into that retirement plan this year if you do things right. And if you're married, that's another $50,000. So that's up to $100,000 you could put in. And so you get a tax deduction of $100,000 right now today. But then the cool thing is the very next day after putting that money in, you can yank it out under this COVID rule. So you put in $100,000, you get $100,000 tax deduction, and then you yank it out and you have that money cash in hand, and yet you only pay taxes on $33,000. It's pretty cool.
That sounds really cool. As I'm sure everyone can see, Tim knows his stuff. So Tim, why don't you talk a little bit about who are the types of clients and people that you work with?
We work the full gamut. We've got the bread and butter type clients who are doing the self-directed IRAs, who are doing the self-directed 401ks. We work with those people. We show them, what they can do with those accounts. And then for those people who have really weird, interesting situations, we work with those too. We've got a lot of people doing the VC thing where they're starting off with assets, with a very low value. I got to tell you guys, I had one guy apologize to me the other day. He said he was only worth 30 million. And whenever you started talking about things, I thought, dude, you don't need to apologize about only being worth 30 million. It's kind of funny. And I bring that up because he does a particular type of deal. It's something called a SPAC. Everybody's getting up in arms about these right now. And it's basically a blind trust investment, if you will, that's publicly traded. But they only put $4,000 or $5,000 into these things, and they're expecting them to pop up in value to $5-10 million. So you can do that all day long with your Roth accounts. Use that to fund the initial investment, and now whenever they pop up in value, woohoo! It's all tax free. It's a wonderful thing.
Wow. Yeah. Now, just a reminder, so if anyone does have specific questions too, feel free to pop them into the Q&A session on the bottom there. We'll make sure we can address those. I think we're going to have plenty of time to go through any Q&A, so feel free to enter that. Going back to maybe some of the pros and cons, Tim, I know that I think I've read or seen that if you invest using a self-directed account, into, say, a crowdfunding campaign, that you're not eligible for the crowdfunding perks. Are there any other kind of considerations to be aware of? Not necessarily cons, but things that people should just be cognizant of when trying to decide whether they should invest through a taxable or a self-directed retirement account?
Yeah, I think they got to be thinking of the end game, because if the asset is going to pop up in value, it's going to go from a small value to a large value. Don't do that inside of a traditional account, because whenever you take it out, it's going to be subject to ordinary income taxes. If you think you're going to get a nice pop, do that inside of a Roth, or do that inside your personal name. That's a big one. If you're a real estate agent, you're going to make a commission, do that in your personal name. I really can't see any cons to crowdfunding otherwise investments using the retirement plan, because the other big thing is, for a lot of people, whenever you ask them where your asset's located, they're going to tell you it's either their home equity and or their retirement plan. So now if we can free up that retirement plan so it can go out and invest in these alternative investments that hopefully are going to make them money, that's a wonderful thing. Whereas if in their personal name, they may not have as much liquid cash lying around. So I really can't see many cons of using the retirement plan as opposed to the personal investing, other than if you know it's going to be popping, do it either in the Roth or in your personal name.
Okay. And then, having been around the industry for 20 plus years, I'm sure you've kind of seen a lot of changes and kind of how the industry has evolved. I'm a little curious, what do you see in, maybe the next 5 or 10 years? Do you see any trends? Do you see anything new on the horizon that people should be kind of keeping their eyes on?
I see the big trend is going to be alternative investments. I think a lot of people are getting out of the traditional investment world of the stock market and everything. And I think they're going into the crowdfunding game of the alternative investments. I think that's a big, big, big trend right now. For people to keep their eye on, once again, just be aware that you don't have to invest in the traditional world. And as we were talking about earlier, Brian, many times it doesn't make sense to invest in the traditional world. If I go to invest on a certain stock, I'm playing against all the various stock analysts. And if I want to do an option, they've got 38,000 computers doing gigaflops of analysis on that option where they're going to rip me off. And I hate to be so cynical. Whereas if I go out and do the alternative investing, the crowdfunding, all that other stuff, I'm not playing against 38,000 different analysts. I'm just playing against other people who are like-minded, and I'm going to be able to have a better ability to find a bargain, a diamond in the rough, if you will, than I will with the stock market.
Perfect. So I'm not seeing any questions, but is there anything else, Tim, that we kind of didn't touch on that you want to talk about?
I can't really think of anything right now. It just boils down to, if you've got capital and you want to invest it without paying taxes on it and you want to have it protected from creditors, it doesn't make sense not to use a retirement plan. That's just the bottom line, really.
So where can people learn more about you, or reach out if they want some of your expertise and advice, Tim?
Well, if they want to learn more about me, the best thing is go to the post office, and my picture is normally right on the wall there. No, I'm kidding, everybody. Easiest thing is just go to my website, IRAideas.com. It has a bio, and it has some stuff I've written years ago, and I haven't updated. I'm a bad person. I'll start updating, promise. But anyways, just go to the website, IRAideas.com would be the best source to get more information.
Perfect. Well, thank you so much for your time today, Tim. And thank you, everyone, for joining us. If you have any other questions or you think of anything else, actually, we do have one quick question here. So it says, this has been very informative and interesting. Would you be able to explain how an ESOP fits into retirement?
Oh, an ESOP, ESOP, Employee Stock Option Plan. Basically, that's a fancy retirement plan. And that's a hell of a question, because if you're the business owner, it could turn out pretty darn good. And that's where you have a company and you effectively just sell it to your company's retirement plan. And they can work out pretty good. If you're an employee, they may or may not work out pretty good. Basically, the ESOP's just another retirement plan. And hopefully, as it spits off income, you have that income available to make the investments in the crowdfunding and alternative investments.
Got it. Hopefully that helps. And now we got all the questions coming in. So it sounds like the best strategy for a joint, fairly high income family, spouse, and another might be to invest in potentially high return investments is within a self-directed Roth IRA. However, some people haven't been eligible to contribute to a Roth IRA for many years, and instead of considerable assets in traditional, what would you suggest as a better strategy? Using a traditional IRA and take a bite by converting a portion of the traditional IRA to a Roth, or invest using a traditional IRA, or take a tax bite by converting a portion of the traditional IRA to a Roth IRA, and then invest using the Roth?
It all depends on the situation. If you think it's really going to pop, take the bite and, as the phrase goes, pay the tax on the seed as opposed to the harvest. So if you got an account that is $10,000, convert that, pay the taxes on the $10,000 as opposed to the $5 million if it's really going to pop. But let me toss you out another idea, because I deal a lot with younger people, as I call them, the young whippersnapper crowd. And, they're 35, 40 years old. And it's not too exciting for them to sit around and wait 20 years before they can access money from their Roth account tax-free. Because to get the money out from a Roth, it has to be 5 years, 59 and a half. You have to have both those things going on to get the money out tax-free. So I tell the people, hey, and also for the high income people, if you're making too much money for your own good and theoretically the IRS says you can't contribute to a Roth, cool. Talk to your parents. If your parents aren't making too much money, have them create the Roth. Now, you loan them the money, help them fund the Roth, help them with the investments in the Roth. Now, whenever it pops up in value, chances are they're going to hit 59.5 a heck of a lot faster than you are. And so now you just have to wait 5 years if it's a brand new Roth that you just contributed and you don't have to worry about the income levels. Now you only wait 5 years to gain access to that money as opposed to having to wait 20 years. And then whenever your parents pass away, I almost said cool, not cool, but it's a sad event. We'll all be sad about it. But they're going to name you as the beneficiary of that Roth. And now you've got a wonderful account, even if you're only 20 years old, even if you're only 2 years old, whenever you inherit a Roth account, as long as it's been open 5 years, you can start gaining access to that money tax-free.
Perfect. All right. Another question here. So it says basically us crowdfunders / angel investors are swinging for the fences, right? You're trying to get those power law returns. If and when our portfolio reaches the max protected amount, can we roll that into another additional account? And when doing so, does that new plan have another new amount for protection, or does state law limit the aggregate protected amount regardless of number of accounts?
Well, I'm not sure what the definition of protected amount is. If you're talking about exemptions from creditors, claims of creditors, yeah, you got some states that are pretty obnoxious about it. I won't even mention the People's Republic of California. They got a rule saying it's enough for a reasonable rate of retirement. And they had a court case a few years back where some guy, I think, had $60,000 and they said that was more than enough for reasonable and they gave it to the creditors. But, if it gets that bad, there's a federal law for bankruptcy that's basically going to protect everything. Well, if you play it right, it's going to protect everything. So we don't need to worry about any limits for the retirement plans if you're going to have a really bad situation, because the federal bankruptcy laws are going to protect you, and we don't really need to worry about the state laws. And going a little bit further, under the state laws, and I know you guys all think I'm a really nice, lovable guy right now, but let me just blow that away right now. For years, I used to work for the dark side. I'd have bankruptcy trustees hire me to go after people's IRAs and show where they've messed up the IRA so we could take the IRA away. And I got to tell you, some of the hardest cases to take those assets away from the people was where they had invested those in loans to other family members' entities off to the side, a 30-year note or something. So bottom line is, even if you're going to build up $500 million inside your IRA and that exceeds the state exempt levels, there's still ways to protect your IRA even whenever it's past the state exemptions.
Got it. Also, someone wanted us to go back and kind of briefly revisit when investing in an LLC again. So whether it makes sense, when you should or shouldn't for tax liability, that type of thing.
Got it. Invest in an LLC. I make a nice living showing people how to do that, charging people to do that. So I think, gosh, yeah, that makes sense to me. If you're going to have a lot of transactions, if you're going to buy a rental property and you got to pay for the plumber, you got to receive rent and all that other stuff, you're going to have 6 or 7 transactions going on a month or more, then having an IRA LLC makes sense. If you're going to be investing in a crowdfunding deal, and you're going to put the money in there and you're going to forget about it for the next 6 months to a year, or you're going to do 3 or 4 of these and you're going to put the money in there and forget about it for a year, I'm not sure that the IRA LLC makes sense. It's probably best just to keep it with the IRA custodian and then have the IRA custodian make the investment. Once again, I'd love to take your money and charge you for setting up the IRA LLC, but it really doesn't make sense if you're just going to be doing onesie, twosie deals and that money's going to sit over there for long term.
Okay. And then it looks like another add-on to the ESOP question. Hypothetically, let's say a small, medium-sized company is in debt and expected to pay off all debt in 10 years. When do you think employees can expect to see benefits from profit sharing? That is, if the company does well after all debt is paid off.
That's tough. That depends upon the situation. I mean, you don't have to have all the debt paid off to be profitable. So long as the profits are exceeding the debt service, life is good. You're going to be making money. To be a little bit snide, it sounds to me like you're an employee of a company and the company founders are playing the game, and they use the ESOP as a nice tax deferral vehicle for them, and maybe it's not turning out so good for the rank and file employees. I don't know. It depends upon your company's profitability, is what it comes down to. But I wouldn't think you have to wait till all debt's paid off. That's kind of silly, because I think every single corporation out there right now has some sort of debt. And if anything, it makes a hell of a lot of sense to take on as much possible debt as you can right now at these stupid low interest rates. Because if you can't outperform 2, 3, 4%, something's wrong.
Perfect. All right. I think we've pretty much wrapped up for the day. I think we can call it here. If anyone else obviously has any other questions that you think of after this, feel free to reach out to Tim. Can contact you, I'm assuming, by your website, iraideas.com. And if there's any other info, Tim, you want to share before we part ways?
I think that's pretty much it, unless somebody wants to text me the lotto numbers. But other than that, no.
Perfect. Well, thank you so much for your time, Tim. Really, really appreciate it. Thank you for everyone for joining us, and we'll see you all back here next time. Thanks.
Thank you, Brian. Take care, everyone.